Hi, good evening, everybody, and thank you for coming on to this webinar. Today, we're discussing the Goodwill Guide, which is covering all of our sales for the period of the 1st of April 2024 up to the 31st of March 2025.
Yeah.
So a busy year, fueled by a lot of extra activity due to the change in business asset disposal relief, which obviously meant a couple of sellers, or more than a couple of sellers, looked to capitalise on less tax and selling before the budget. I'm here with Julie Randall, our newly promoted Associate Director.
That's
so
right.
Congratulations,
Thank you
Julie.
very much. Thank you.
I know that you've got a lot of people that you deal with and a lot of clients that are on this webinar, so I'm sure you're going to get a lot of congratulations, as you already have. Well deserved. So as in terms of this report, we're going to go through goodwill values and multiples and touch on group and independent sales. But the first thing that I'd probably like to just touch on is multiples. Okay. And there's a lot of focus on multiples within the market, whether it's a 7, a 7.5 or 8 times or more. And I don't think there's enough attention actually given on calculating the fair maintainable trade or calculating the EBITDA, how it's calculated, what goes into it. And that figure, in my opinion, is a figure that we should concentrate more on the multiple.
Absolutely.
You know, the multiple is determined by the market. So we're putting a multiple based on comparable data. But what I'm certainly seeing in the market is agents undervaluing the EBITDA. And that's a really big figure. So just going to give an example. So let's say a practice has a 300k EBITDA, so an associate-led EBITDA. Now, the difference between a 7.5 times multiple and an 8 times multiple would be 150k in sale value. Okay, so a considerable amount. But if the EBITDA within that practice was undervalued by, let's say, 30k, and even if you apply the 7.5 times, that's a loss of value of potentially 225 grand.
Big difference.
So if you focus just on the multiple and you don't focus on the EBITDA and getting that bit right, you could be undervaluing the business. So whilst aiming for a higher multiple should always, of course, be the job of an agent, calculating and getting the fair maintainable trade or EBITDA is equally crucial, if not more so. And I guess that's what we try and deliver as an agent to make sure that you're maximizing your business sale. So Julie, before I talk too much, do you want to go into an introduction?
Absolutely. So we're going to look at really tonight lots of different points, but we're going to focus starting on the market overview. So the dental practice sales market really has remained highly active over the past year, which we'll see in the Goodwill report. So according to the latest data, we're looking now at the average practice sale price is now 1,267,078, and that means that 69.88% of all our transactions were completed by independent buyers, and this is returning to the 2023 levels. So really positive to see that 70% of all the transactions are with the independent buyers.
And just to mention, and our data pool within this report is of circa 100 completed transactions.
Absolutely. So we've got a great pool of information on there. So the rest, so obviously the 30%, were bought by our group buyers, which includes the corporates, the multi-practice owners, which we class as tier 1 to 4 buyers. So this split really reflects the two ongoing trends. So if we look at those two ongoing trends, we've got a really strong appetite, and we're seeing that more and more with new buyers coming to the market from first and second time buyers. And this is often supported by bank financing, which we expect to continue given the base rate dropping that we saw last week and the forecast really for further cuts throughout 2025. So point 2, we're continued expansion. So we're seeing the continued expansion by the groups, particularly as we'll look at those in tier 4, so owners of 4 practices, and those really who are becoming more active in the market. So Phil, if you were over to you to explain the group summary.
So as you'll see in the report, we split the groups into tier 1, tier 2, tier 3, and tier 4. Principally, tier 1 is your big groups. So that's your My Dentist, etc. And then we go tier 2, tier 3, and tier 4. Okay, so the average sale price last year to groups within them tiers was 2.36 million. Okay, so when we're talking about group sales, this is all of the sales to buyers that work on associate-led EBITDA. Okay, so just to explain what associate-led EBITDA is, I know we've explained it a couple of times, but it's key to really explain that. Is what we're doing is we're calculating the profitability on a fully associate-led business. So to explain that quite simply is if you were doing as an active principal 100k of revenue within the business, we would adjust the associate fees to represent that delivery being paid out, i.e., we'd add in a 45k cost for you being based on 45% and take off the lab bills. Okay, so we're factoring in your associate delivery to value on the basis of an EBITDA for how a group would look to value. Okay, so the average sale price was 2.36 million. So what are the trends that are made up of that? Now, if we look at the tier 1 buyers, that's the big groups, is what we're seeing is they're actually having to acquire higher grossing practices.
Absolutely.
Okay, so they're looking at opportunities of revenue circa 1.52 million. And the reason why tier 1 and the bigger acquirers are having to move to larger opportunities is, number one, is they want bigger practices and they want to acquire high levels of EBITDA to add to the group. But in some cases, they're being almost priced out in terms of value and terms from smaller opportunities, i.e., potentially a 1.5 million to 2.5 million acquisition. And that's because the data in this report and the ongoing trend in what I think will continue in 2025 is the emergence and the strong appetite from tier 2 to tier 4 buyers, especially them tier 4 buyers.
We're seeing that now.
Individuals that own anywhere between 3 and 10 practices that have probably paid off a lot of debt over the last 5 years. They've probably expanded their group and benefited from the growth of their group, as I mentioned, paid off debt, and they're looking to acquire and form a micro-consolidated group. Now, these buyers, what we're tending to see, as the report will show, will pay higher multiples than the corporate groups. But what they'll also probably do is have a better deal structure.
Absolutely, that's what we're seeing. Much better, the deal structure.
So in some cases, 100% on completion, or even 80 or 90% on completion, and maybe a cash deferred instead of a targeted deferred, i.e.,
which is a lot better.
100%, the more guaranteed of the purchase price you can achieve is better. So, is in terms of what that's meant from the bigger corporates is actually they can't compete with them multiples and them deal structures. So what they're having to do is acquire higher grossing practices and higher value practices where really the micro consolidators don't, for example, want to take on £4 million of debt for a single practice. There isn't the upside to them of buying that practice. A lot of the low-hanging fruit's probably been capitalized by the principals to get to that high turnover and high valuation. That realistically what they want is to pick up a practice where there's growth potential left, where they can benefit from running it as part of a micro-consolidated group. So just to summarize the groups, average EBITDA multiples as an average on a whole is 7.16. The trend is for certainly mixed practices and private practices are achieving the highest multiples. Again, regional multiples are outlined within the report, so please feel free to go through that. NHS practices at this are increasingly in demand, and the multiples, I think, are increasing. And
we can see that reflective of that.
You can certainly see it, and I think my prediction will be that when we do this webinar again in 25-26, that we will see stronger multiples for NHS practices. So as with all markets, there's a cycle, and I think NHS, based on recruitment being slightly easier at practice level, the ORE being expanded, and the route for foreign dentists being easier, is I can see NHS practices becoming more favourable from a group perspective and a guaranteed income. And of course, independents will always like NHS. Of course, if you've got any questions about groups, then then please let us know. But I think now I'm going to hand over to Julie to really go through
our independent buyers
and what FMT is. And
absolutely. So if we really look at the independent sales summary, I get asked a lot is really what is FMT, or fair maintainable trade, and that's something that's really important to class out. So what we're looking at with the fair maintainable trade is the clinical profit in an owner occupier. So basically, in layman's terms, if somebody's going to come in and work in your practice, clinically, they're going to earn 100% of what they generate. So typically we will see the fair maintainable trade higher than the EBITDA, obviously, because we're not paying you out as an associate, as Phil has sort of said. So really the independent market is still the largest and the most active segment, of our sales. As I said, alluded to before, 70% of our sales are still into the first-time buyers or those acquiring a second site. I do want to add in, and I think it's really important, I do want to add in a disclaimer here, because it's very easy to really focus on the average multiples in the report, and then what you will do is then automatically link them to your practice valuation and your sale price. So I really wanted to expand on this, because the report does show higher grossing turnover practices do achieve slightly significant higher multiples than lower turnover practices, which reduce this average down. So we do see anomalies within our data when we're looking, quite in depth at the information that we're looking at to produce obviously these figures. We do see some anomalies that are going to bring that down.
And just to touch the point on that is what we really see is let's say you've got a practice with a 200k revenue.
Yeah.
Okay.
Yeah.
The acquirer or the purchaser isn't benefiting from the profit of associates and the income that they're delivering.
Yes.
So effectively, if you've got a practice with a turnover of 200k, the likely profitability once you pay for the loan, staff, rents, all of these things, is likely going to be, let's call it 80k. Okay.
Yeah. For the incident. Yeah.
Now, if you're an associate out there grossing 250k, 300k, you're probably netting 120k. So actually, you're better off being an associate than in most cases buying
a practice,
a low turnover practice.
Yeah.
And that's then reflected in the multiples of which then practices achieve.
Exactly. So that's where we will see the lower multiples. So I'll give another example as well, really, for the last 3 NHS practices that we've agreed with a revenue average of about 550,000 in London. They've achieved a circa 5 times fair maintainable trade FMT, whilst the report, you'll see in the report, does show an average of about 3.73 times.
And they were NHS practices.
They were all, they were fully NHS practices. So what we can see is from these figures, the average price achieved is 795,874. And then if we go on to the average FMT multiple, we're seeing that at 3.31 times, which positively is slightly higher than last year at 3.24 times. So we are seeing, as Phil says, a circle coming round, and that deal multiples do range, as we've touched on, from as low as 0.87 to 7.01 times. And this is really dependent on your location, your buyer profile, and really the practice fundamentals. So really by practice type, if we break that down further and look at mixed practices, the mixed practices are leading the field. With an average multiple of 3.84 times and the sale price now exceeding 1 million. It offers so much more, for our buyers. They can grow the private, there's also the NHS, so it's guaranteed income there. The NHS practices are at 3.1 times, with the buyers really valuing that contract sustainability as possibility. The private practices really at the moment come in at 2.96 times, but as Phil said, in prime areas, they really can achieve multiples over 5 times. So, despite the regional differences, practices with higher turnover and growth potential achieve better outcomes, especially where, the buyer demand is strongest.
Yeah, and I mean, my thoughts on the owner operator market is it's continually going from strength to strength.
Yeah.
As opposed to the group, if we look at the group market and you look at the data and the regional differences. Actually, there's not too many regional differences in terms of multiples.
No.
Group buyers, especially the tier 1 buyers, will pay similarly the same multiples as long as it's not an area which is hard to recruit in.
Exactly.
But if we look at the owner-led market, there are some areas of the country which year by year buck the trend in achieving high multiples. For example, London and the Southeast. If we look at the Midlands, if we look at the Northwest and the Northeast, are really hot spots for practices. And as much as we're going through the Goodwill guide now for the previous 12 months, all that we can say is when we're looking at launches at the moment, they're achieving significantly more interest and viewings.
Absolutely, absolutely, we're seeing that.
That's driven by the lower base rate, cash-rich environment in which we operate as a dental practice broker and healthcare. There's a lot of family money out there.
There is,
but especially on the owner-led multiples, I'd certainly say it's on an individual practice basis.
And it's really important to focus on that, really.
100%. In terms of key drivers and trends moving forward, several factors driving the current Goodwill valuations. Lender support remains strong for well qualified buyers, buyers with 10 to 20%. We're seeing a number of healthcare lenders come back into the industry, which is meaning lenders are having to sharpen their pencil on the deal terms that they're offering, which is great news for everybody. As Julie mentioned, mixed practices really dominate the market, and we expect that to continue. Tier 4 groups are especially influential in the market. These buyers are flexible, they're aggressive in bidding, and they're willing to compete on deal terms. I've got one example of a practice in Kent at this moment of time. The vendor had 3 offers on a 70% upfront basis and 30% deferred. And then he had an offer from a micro consolidator tier 4 who offered all on completion. So where he would have had to have 600k deferred linked to targets, he's now getting that all up front. So my one bit of advice to anybody out there is certainly doing a whole market launch. When launching and not pigeoning yourself to 2 or 3 buyers, when your best buyer could be a micro consolidator, which may not have been picked up through a direct approach. We're also seeing, of course, with deferred consideration, them higher grossing practices, circa 2 million, as I say, for tier 1 buyers. There's no getting away from them deal terms. That's just simply what they are. People considering a sale, what should they look out for? Do you think in 25, 26?
I think for practice owners considering a sale, let's just focus and recap on those points. Mixed practices are in high demand regions are achieving top valuations. So buyers are plentiful. Both at the group really and the independent level, especially as Phil has just said, and especially regions like London, the Midlands, Northwest, Northeast. So growth potential is key. Really, really important to focus on the growth potential, because buyers, they want to see a benefit of ownership. There's lots of things, but really in terms of growth, to increase profitability, but also, future arbitrage for when they sell. So that's something that they've got to consider. How long are they going to own the practice? Is that going to be, 15 years?
Or 5 years?
Or 5 years? Nobody knows, so that's something that they've got to be able to look at. And then the seller readiness. So what really, as valuers, we really, really want to see, the latest accounts is key to maximise evaluation, and really attract the interest, because they also want a good growth story, a good team, strong current performance, but also looking at the investment in the practice, in the site itself, i.e. it looks well presented. All of these remain a key, factor.
And it's a key factor, investment in the site. And we don't recommend somebody goes and spends 50k on a new CBCT for the buyer to benefit from. Ultimately, what we do see is invested practices in terms of where a buyer doesn't need to spend 100k in capital expenditure, achieve higher multiples. Okay, because somebody is factoring in the cost of capital expenditure into their offer. So if somebody needs to spend 50 grand, they're certainly going to reduce probably the value that they're willing to offer by 50k. You know, so whilst you don't need to go and spend considerable sums, is actually having it in a good state will certainly attract.
Exactly, and buyers want to be able to see that they can put their own stamp on, you know, so they're going to come in, certainly not do anything for the first 6 to 12 months, but they are going to want to be able to ultimately do the practice how they want it at the end of the day.
Fine, so some final remarks then. In summary, the Goodwill report for 2025 shows both a resilient and competitive market across the board for dental practices. So whether you're planning on selling this year and to capitalise on the change of budget, again, the business asset disposal relief is going up to 18% on the 6th of April. So if you've got £1 million allowance, you know, and you complete after then, you'll be paying an extra 40k in business asset disposal relief if you've got £1 million gain. Now that can be offset by owning the practice for a few months after that period, so you shouldn't hinge your decision on that tax change unless it's important to you, of course. But some key points: really know your numbers, get a realistic valuation which is data led but focuses both on ensuring the EBITDA and fair maintainable trade is correct and at the maximum level, as well as the multiple. Understand your buyer pool, you know, the difference between independent buyers groups and the tiers, and who you're looking to attract. Position your practice for growth, you know, highlight to buyers opportunity, not just stability, because buyers want to see growth potential, whether that's different income streams or adding another surgery, etc., etc. But the one thing that we do encourage everybody to do, and all of our sellers out there to do, is plan early, get a valuation early. You know, 1 to 2 years before, even, you know, we've valued clients for 5-10 years.
I was just about to say that, you know, I've been working with a lot of my vendors over the last 5 years or 6 years or longer, and we value the practice year on year, you know, for growth as well, but also we're telling you what type of buyer you're going to have and all these sorts of factors, and I think it's just vital to have that.
It gives you an insight into potential tie-in periods, deal structures, etc. But more so, you know, they're free of charge, they're no obligation, and they provide a fantastic insight into both the market and where your practice fits. So if you'd like a free, no obligation valuation, please reach out to us. You can go on our website, dentalelite.co.uk, and request a valuation. Alternatively, you can email Julie or myself, phil@dentalelite.co.uk, or julie.randall@dentalelite.co.uk. I know we've probably valued a lot of the participants on this webinar.
Yes, recognise a few names out there. So it's thank you all for joining us. It's been really, really good.
Thank you, and speak soon.
Thank you.